Why buying property in a trust could destroy you. This is the hidden $16,000 a year land tax trap. What if I told you the structure you bought your investment property in could cost you $80,000 in land tax for literally doing nothing, not flipping it, not developing it, just owning it? Welcome to New South Wales, where using a family trust is like ordering a Wagyu steak, getting punched in the face with a land tax bill instead. Today, I'm diving into a trap that's burning Aussie investors, especially the ones trying to be smart by using trusts. We'll unpack today the real land tax risk in New South Wales when using trusts, why selling in the wrong year could bankrupt you, and whether companies, SMSFs, or personal names make more buying sense, and how polys keep gaslighting you with exemptions that don't apply, and why some expert advice from our online gurus or even mortgage brokers like myself sometimes is leaving people in a 5-figure tax debt. So if you're a millennial or Gen Z investor trying to be tax smart but not end up broke smart, this video is for you. Firstly, guys, let's talk about the land tax trap no one talks about. Here's the stitch up, guys. In New South Wales, if you buy a property under a family trust, it's classified as a special trust, which means, guys, there's no land tax free threshold. Zero, zilch, nada. And as of 2025, the land tax threshold in New South Wales is $1,075,000. If your land value is under that in your personal name or a company, no land tax. That's correct. Personal name, company name, no land tax. But if it's under a trust, you pay 1.6% from the $1. Now, to quote Revenue New South Wales in 2025, they've said, quote, special trusts are not eligible for land tax thresholds. The land value is taxed at the premium rate, end quote. So if your land is worth $1 million, you're going to be slapped with $16,000 per year, like for literally just holding the land. Now, I'm going to throw this on the screen just to show you the difference between trust structures and a company structure. The trust, if you buy a piece of land or a property on a piece of land like a standalone property, just going to the screen over here, a special trust, which includes common types like family trusts, discretionary trusts, or a unit trust, do not receive land tax thresholds in New South Wales. That means, guys, if you look at the screen, you have to pay land tax from the first dollar. However, guys, if you get under a fixed trust, and mind you, if this strictly meets the requirements under the Land Tax Management Act 1956, for example, you have unit holders who are presently entitled to all income/capital and who cannot be changed at the trustee's discretion, you may qualify for an exemption. However, you need to put your case forward with Revenues New South Wales. However, guys, if you look at the next screen, I'll put up over here, for properties purchased under a company name, companies do receive land tax thresholds. And it's the same threshold under a personal name, which is $1,075,000 in New South Wales. But however, guys, remember, this is for the first company only, right? Don't get trickery with the Revenues Office, right? Don't go get multiple companies and buy individually in different company names and go, oh yeah, I'm exempted from land tax. It's the first company, guys. However, guys, before you discount the use of a family trust or a trust structure to buy a property, according to former New South Wales Treasurer Matt Keane, he says, quote, family trust offers flexibility in estate planning, but they're not intended for tax avoidance, end quote. So be careful, guys, when you're being sold the idea of, oh, let's buy in a trust, let's buy a property in a trust. It's so good. For example, to quote some property investor guru that you see a lot on TikTok, they'll say something like, quote, set up a family trust to protect your assets and distribute profits and get all the tax deductions. Oh my God, it's so good, so simple, end quote. I'm like, yeah, mate, really simple, you property spruiker. I mean, guys, I'm all in for you guys to listen to these property spruikers because, you know, if you're happy to pay $80,000 in 5 years for just existing, then go for it, right? But this is my honest opinion. I think there is a special place to buy property under a trust. I do help my clients buy property under a trust with the help of an independent financial advisor, independent accountant, and independent buyer's agent. But I don't just off the bat tell a client buy a property under a trust without them doing their due diligence. For example, the things I've just said just then. I'm telling you right now, those property spruikers that's online selling you these courses, oh yeah, it's so easy to buy property under a trust, you can buy multiple properties under a trust. They won't tell you this. Because you know why? They're trying to close you to use their services. They're probably charging you $10,000 to $15,000 to use their services. And what's the easiest way to convince you to buy a property? Well, buy under a trust. It's so easy. Until you find out you got duped. Secondly, in this video, we're going to talk about the CGT timing disaster, the capital gains tax timing disaster. So guys, these are the things that you think you're being smart about capital gains, but you're not. For example, I see a lot of clients, they don't time the sale of their property right. For example, they have an investment property and they forgot in that financial year, when they decide to sell that investment property, they, for example, earn a lot of bonus. Or for example, their wife got a pay rise. Or if you're in sales, you got a high commission. Therefore, if they sold their investment property in this high income year cap, which means you're going to get taxed at 45% plus a 2% Medicare levy surcharge, which brings you on a 45% top marginal tax rate. Plus, you sold your property during that time. For example, you bought it for $500,000 and now you sold it for $1 million. Even if you bought this property under a personal name and you get a 50% discount, that's $250,000 on your total high income year within this financial year. Have you had known that? Or for example, you've spoken to an independent financial advisor or an accountant, they may have told you, mate, maybe this year, this high income year where you have all these bonuses and commission is not the right year for you to sell this property. Or for example, another capital gains mistake is you forgot to move back before the 6-year rule. For example, there's a 6-year CGT exemption. As you guys know, if you lived in the property for the first 12 months and you sold it within 6 years, there's no CGT. But what happens is you rent out the property, but you pass the 6-year rule and you forgot to live back in it. A lot of you guys don't think about that when you're selling the property. And what happens? You get banged with CGT. Or for example, here's another example. You bought an owner-occupied property under a company name and you're thinking, hey, sweet, I should be exempt from CGT. But let me throw this up on the screen. If you bought a property under a company name for owner-occupied purposes, do you get CGT exemption? Well, the answer is no. Owning a property through a company does not entitle you to CGT exemption. And also, under Division 115, under the Income Tax Assessment Act, companies are not eligible for the 50% CGT exemption. This only applies to individuals and certain trusts. For example, I said just then, under fixed trust structures or unit trust structures. But again, guys, seek an independent financial accountant to verify this. But I'm only highlighting this just to show you that some of you guys are pretty ignorant in terms of what you think is a tax exemption. According to the ATO data, over 83,000 Aussies triggered CGT from property disposals in 2021 to 2022 financial year. And do you know what is the average tax liability? It comes up to a whopping number of $46,200. According to the ATO spokesperson in 2024, they said, quote, CGT can be minimized through correct structuring and timing, and taxpayers must understand their obligations, end quote. And this is my take, guys. The mobs in Canberra, they love it when you sell too early. It's like they're charging you rent to leave the monopoly board, which when you think about it, it's ultimately rigged. And thirdly, guys, in this video, I'm going to talk about while everyone's obsessed with the trust, with trust structures, but no one talks about the negative points of buying a property under a trust, and I'm going to talk about it. Firstly, let's talk about why everyone's frothing over a trust at the moment. Like, for example, let me list out the benefits. Number 1, you can split rental incomes across family members. Number 2, you can park profits in bucket companies. Number 3, you can protect assets from lawsuits or ex-wives or ex-husbands. But none of that matters if your investment is negatively geared or if the land tax wipes out your returns. I mean, you guys hear this all the time on this platform, TikTok, IG, YouTube. Like you hear from some random accountant on TikTok that says, quote, oh, trust helps you legally avoid paying 40% in tax, end quote. But according to a New South Wales Treasury official or spokesperson, they said, quote, trust must be transparent in their tax obligation. Misuse leads to penalties, end quote. And guys, this is my take. You're not protecting your legacy if your legacy is $80,000 in land tax in over 5 years, and now you have a daughter that you thought you leave this property for your daughter who now hates you because you brought it in the wrong name because she saw this video and go, hey dad, you're such a dummy. Fourthly, guys, refinancing is better than selling. This is the untold hack. Instead of selling and triggering CGT, why not refinance? Because this is what the hack is, guys. As a mortgage broker for the last 15 years, this is the untold thing that the ATO doesn't tell you. Because you see, the bank don't tax equity withdrawals. The ATO can't tax equity withdrawals because technically the bank loaned it to you. You're borrowing against your own win. And according to CoreLogic in 2024, they said that medium city house prices grew from $1.29 million to $1.61 million. So if you bought a house in 2022, that's technically a $320,000 in theoretical equity. So if you're smart, guys, like my clients, my investor clients, instead of selling and paying 23 to 47% in CGT, you just simply refinance and pull out that $250,000, for example, 80% of that value, and just reinvest it or just retire on it. And whilst you're using that money, which you would have sold the property and get CGT taxed, you don't get taxed on this. And meanwhile, while you're using this equity to buy another property, this money, the interest charge, is tax deductible. Haha, smart ain't it? Now to give you a bit of a counter view, like you hear from some gurus on LinkedIn that says, quote, cash flow is king, equity is a lie, end quote. But me being brutally honest on that, Bro, if you're not refinancing your equity, you're just sitting on a golden egg and eating boiled rice for dinner. That's probably you now watching my videos and eating rice with dinner. And fifthly, guys, how to actually minimize CGT without getting burned. Because alright guys, I understand, maybe refinancing isn't your vibe. And for example, you're like, hey Q, I have to sell. Well, let's talk about how to avoid getting absolutely cooked by the capital gains tax mob. Because here's what most first-time investors don't realize. There's actually a whole buffet of CGT exemptions and discounts, but you only get to eat it if you follow these following rules. Because according to ATO, they said, quote, the main resident exemption, the 50% CGT discount, and the 6-year absence rule are key relief mechanisms available to eligible taxpayers, end quote. And according to the Financial Review, they said, quote, many investors overpay in CGT due to poor timing, lack of documentation, or owning property in the wrong structure, end quote. So guys, here's the cheat sheet. Number 1, use the main resident exemption. So for example, if you lived in the home as your main primary residence, you could be exempt from CGT entirely. But then guys, I'm going to pull you in there for those migrants and those bloody lebers out there. You actually have to live in there. Guys, don't be dodgy, right? Don't be dodgy, guys. Just because you change your address on MyGov, it doesn't count, guys. So don't be sneaky, guys, because I know a lot of you yallas are getting caught these days. Second tip is use the 6-year rule. If you move out and rent it, the ATO lets you treat it as your main residence for up to 6 years. No CGT, but only if you don't claim another residence during that time as your prime place of residence. So all I'm saying, guys, is don't be greedy. The third tip is use the 50% discount. So for example, if you hold an asset for over 12 months, individuals and trusts get a 50% discount. However, guys, for those who have bought it in a company, nope, no discount. Not even a birthday card. And the number 4th tip is the market valuation reset. So listen in closely, guys. If you turned your PPOR, which is your prime place of residence, into an investment property, you can actually technically reset the cost base to the market value at the time you moved out. Only if you do a proper valuation on this property. Like, I'm not talking about like some napkin guess from your mate's cousin or something, right? It needs to be a proper valuation from an independent valuer. And sometimes, guys, even a bank valuation won't cut it. And the 5th tip, guys, is look at renovation costs, stamp duty, and holding costs. So what I'm talking about, guys, is if you've documented those costs properly, those costs over here, they can increase your cost base, which means less taxable gain. And yes, even the $20,000 kitchen reno that your partner said, oh, why are you doing this bloody reno? And then you reply and go, hey, I watched the block and I want to do this 20,000 reno because I'm inspired by the block. Well, you know what? You are right. You can actually add this to your cost base. And right now you can walk over to your partner and smack him or her in the head and go, hey, I was right. But guys, seriously, this is my opinion. If you don't plan your CGT exit like it's a tactical military operation, you'll be definitely ambushed by the 6-figure tax bill while you're halfway to Bali thinking you cashed out big. So yeah, guys, if you watch the end of this video, let me wrap this up. The police don't want you to know this. Like, for example, they sell you these dreams in days that they value and prioritize home ownership for every Aussie. But then in the dark alleys of the and the they'll punish you for using legal structures to plan your financial future. They'll tell you things like, oh, super is tax effective. But then they slap you on the face with a 30% tax over $3 million in your super. And on one side, they say to you, land tax is fair. But then they go back and remove the thresholds that you bought it in a trust. Like, for example, old man says, quote, Australia's tax system must remain fair and flexible, end quote. But then if you listen to TGB, you know, the voice of the nation, they'll say, quote, they'll tax you for dying next, end quote. And guys, this is my view. It's a rigged game. You either learn to play smarter or you just get played. So yeah, guys, if you've been on this platform for a long time and you hear from property spookers that say, oh, buy a property in a trust, it's always better for you. I'm sorry, I hate to break it to you. It's like basically saying to you, all utes are good investments because your uncle's Hilux lasted 15 years. It just blatantly bites advice, wrong structure, and right now you bought a property under a trust, you own Revenue New South Wales $16,000 a year for a safe asset. So right now, if you want to actually build wealth and not get eaten alive by CGT, land tax, and amateur TikTok property influencer advice, then you seriously need the right game plan from day one. So what I suggest to you is you book a 15-minute strategy call or a 60-minute deep dive with me for me to provide you with an independent, holistic lending solution where I can pair you with my independent financial advisors, independent accountants, and independent buyers agents for us to create a A-game property strategy for you to build your property portfolio and avoid all those bloody tax landmines so you don't get blown up whilst trying to pursue generational wealth and end the generational poverty curse in your family, I suggest you do so right now because I'm getting bloody booked out in August and my September bookings are filling up very fast. However, guys, if you're not ready, just hit a like button for this video, hit a follow for this video if you want more videos like this, and most importantly, smash the share button because knowledge is power, and share this knowledge to your mates. And until next time, I'll see you in another episode of That Property Roast.